All right, folks, in this video, I'm going to explain why we use trailing stops and why we use stop losses. Well, the reason for us using trailing stops and stop losses is to get us out of a trade when the market moves against us. When the market moves, it can move fast enough where we might not be able to quickly exit a trade manually. So having a stop loss already placed makes it easier for us to make sure we're getting out of a trade right at the time where we should be. Now, on the software, the TrueEdge software, we're able to see a chart of the stock price, but we actually cannot see a chart of the options price. Now, in general, when you're trading the options, you should be making your decisions based upon where the stock price has gone to. So, for example, let's say we were looking at VKTX, which had a really nice move today. And let's say we had an options position and call options, and we are holding that position all the way up to here, and then the stock starts to come down. Now, based upon our methodology of trading stocks, we would know that once this sharp retracement occurs, it would be time to exit the trade. Now, when we exit the trade for a stock, we could have a stop loss placed, let's say, somewhere behind the market. Let's say we place one there just to get us out in the event the market turned around. But for options, we could not place a stop loss for the stock, for the options using the stock price. We can't put a stop loss on this chart because this is a plot of the stock price. So if we're placing a stop loss on the options, it would have to be based on the price of the options themselves, which of course are going to change based upon how far up or down the price of the stock moves. Let's switch over to VKTX just to show this. So here's VKTX. You can see right now, if I were to buy this 73 call, I would be buying it at $1.85. And if I were to sell it right now, it'd be at $1.55. That's a pretty wide spread between the bid and the ask. It's 30 cents wide. So this would probably not be a good idea to try to trade options on this stock, because if I were forced to make a quick exit, I would be exiting at a price that's most likely 30 cents lower than the last price that traded on the options that I'm in, which could mean that I might turn a good profit into a smaller profit, or I could turn a win into a loss. But if I'm looking at something more liquid, let's say like Apple, and I pull up Apple options, then I won't have that issue with a large distance between the bid and the ask, looking at about 2 to 3 cents between the two. So something very reasonable. So when I place a stop loss on options, it is going to be based strictly on the price of the options themselves. It cannot possibly be based upon the price of the stock, because the stock obviously is trading at a different price than the options contracts are. Now, that also means that if I am going to make my trading decisions of when to exit a trade based upon what the stock price is doing, then I will have to make an exit on the options position once the stock price crosses a threshold that I don't want to accept. For example, let's say that I bought a put option for Apple right now. Apple's going up a little bit at the moment. So let's say I bought a put option. I'm going to buy the 230 put that expires on October 25th. So I just got that option. I'm going to highlight it right there. Now that I bought that option, I want Apple's price to go down because I bought a put, but Apple's price is going up. Now, what if I decide that if Apple's price goes to the price 230.30 or higher, I want to get out of my trade? Well, when the price hits that price, it just did, I have to exit right now. If I want to get out, I'll have to do an exit. I can right click to cover at market, or I could simply sell the options at market. Either one will work, but that'll get me out of my trade that currently is losing. However, if I place a stop loss, the stop loss is going to be based on the price per option. So if I decide that that's the way I'm going to make my decision, then what I would do is place a stop loss that is at a price lower than where I got in. So if I got in at $1.10, and I don't want to lose more than 20 cents per option, then I would place a stop loss at 90 cents. right? So I would just do just like this, 90 cents, choose a stop, and hit sell. And now I've got a stop loss at exactly 90 cents. So if the option's price value goes down to 90 cents or below, then I'll have a exit triggered to get me out at a loss, right? And if I were to use a trailing stop, of course, I would choose whatever is appropriate and go from there. But if I'm making a decision based on what the stock price is doing, then I would have to monitor the stock price either by setting an alert, such as this, where I could just say if Apple's price goes to greater than 230.30, which it already has, and if I add this into the system, as soon as I hit add, I should see an alert pop up. There it is, which says the last price of Apple is 230.30. So now I know that it's time for me to get out because I've set the alert to let me know if the stock goes too far in the wrong direction. And then once that alert hits, all I would have to do is go to sell at market my position. Now I currently have a stop loss entered. So if I'm going to sell, I need to cancel this one first so it doesn't accidentally execute a trade after I've already gotten out. Then I hit sell, and now I'm out of my position at a loss, right? So my average sell price was at $1.03. My average entry price was at $1.10. We saw that before. So I've lost 7 cents per share on my options position. So it's very important to understand that when you're trading options and you're looking at the direction that a stock is going, you won't be able to place a stop loss based upon the stock price itself because you can't do that. The only way you can place a stop loss is based upon the options price. However, you can let yourself know when the stock has moved too far in the wrong direction to make sure you're aware of it, so then you can go ahead and exit your options trade. Or if you prefer, you can use the stop loss feature for options to get you out in the event that the stock price, the options price moves too far against you. So those are the basic rules that you'll have to accept, and those are the things you'll have to do. This concludes this explanation. Hopefully that helps. Thanks, folks.